Hello everybody. So I am titling this video Super Gems. I am looking for stocks that have it all. And especially in this list of stocks today, I'm going to highlight a rule of 54 plus. A rule of 54 plus in addition with high growth at 28% plus and cheap. So I want them cheap. I want super high rule of 40 at a 54 plus, and I want high growth. And so I have a few new stocks that I'm highlighting in this video. If you've watched these videos before, you know how they are. It's all about the screener, and I am screening ever more stock. I've lost track at how many I have now, maybe about 150. This is all thanks to my Patreon. You've all motivated me to add more stocks to the spreadsheet and screen for more stocks. I have 170 rows so far. By the way, this is my spreadsheet under construction, which I will release. And I'm very pleased because some of the stocks that I added to the spreadsheet were recommended in the Discord, recommended in the Patreon. Anyways, let me get started with the list. And before I do, I just want to introduce a few things if you're new to the channel. So the first thing is I use enterprise value. I don't use market cap. Market cap is an artifact of the past. A lot of the reason why people still use market cap is because that's what there was in the newspaper back in the 70s. Market cap does not penalize companies for debt, and market cap does not reward companies for having a bunch of cash on the balance sheet. Only the enterprise value does that. Enterprise value is a much better way to assess how much am I paying for the company, for the stock. What is the price of the stock? I've also added to the spreadsheet, I've added the stock price to know where we're at. If you watch this video when it's been out for a long time, you can look at it. And I added the 52-week performance. So some stocks are cheap relative to 52 weeks ago. Others are more expensive. You know, HIMS, Gigacloud with the run that these two have had, right? It looks like it looks like the run's gone, but they are still extremely cheap on my spreadsheet. So beyond enterprise value is forward revenue growth. I care greatly about forward revenue growth. The higher the growth in the next 12 months, the better. And if that growth is sustained, that growth, of course, you're going to have a lot of diminishing numbers. And of course, the growth, so for him, so it's predicted to go at 53% by analysts over the next 12 months. That means that maybe next year it does 48, and maybe it does 45, and maybe it does 42, right? But you compound at a very high rate. And because it's a compounding over the years, actually, I think it's even a mistake to consider a stock that, say, would be growing at 15%. That's just not enough. I'm going back to like the early days of the channel where I'm a growth snob and I want 30% at a bare minimum. And I won't nitpick for Genmab, where I'll talk about here, where they predicted to go at 28%. I included them because I find them quite interesting and I want to discuss them. So there's still a little bit of quality in this spreadsheet where I hand select the stocks. It's not just my spreadsheet telling me the stocks, because if my spreadsheet was selecting the stocks for me, half of these would be Chinese stocks, right? Half of them. And of course, I know a lot of people don't want to invest in Chinese stocks. I don't own Chinese stocks right now. And so, a lot of people don't want to touch Chinese stocks. So that's why you gotta add some qualitative component to it. Talking about another aspect I care about is EBITDA margin. I don't do pre-revenue companies. I am not equipped to understand pre-revenue companies. It's a little too risky for me. I think, if someone's starting out, they're in their early 20s and you want to take a risk on a pre-revenue company, that's fine. Me, I still want my companies to not go bankrupt. Companies getting deleted from the portfolio, going bankrupt. I mean, it's just... Yeah, like rule number 1, don't lose money. Rule number 2, don't forget rule number 1, right? Warren Buffett about losing money. So I want my companies to have EBITDA margin that is positive, and I use EBITDA margin. That's my proxy for cash flow. That's what I prefer. I don't like earnings, right? I view depreciation, I view amortization as phantom expenses. I don't view them as real expenses. Even though some people claim they are, I just know it's an artifact of accounting. And so that's why I use EBITDA. And you could say, oh, I could use earnings and DA. But, it's like EBITDA is the common metric everybody reports. And it's much easier to compare EBITDA margin to EBITDA margin. Everybody calculates it the same way. It allows me to compare. And then kind of my spreadsheet metric that I love the most is enterprise value over gross profit over revenue growth. And it is a spin on the PEG ratio of Peter Lynch. as I've dubbed it before. It's like my own version of a Peter Lynch ratio, where I don't use market cap. I use EV because I prefer EV, as I explained, and I use gross profit. I don't use earnings. And why do I use gross profit and not earnings, or not even EBITDA margin, right? I could use EBITDA margin. Well, because I believe in a lot of companies, a lot of the operating expenses, as we call them, could be construed as an investment. For example, marketing, right? A typical operating expense like marketing. Is that an investment or is that a cost, right? You spend $7,000 to sell a Lexus, that's definitely a cost, right? You're not having recurring revenue. In the 1960s traditional legacy company, and something like marketing is an expense, and so it makes sense to use earnings down the line. In a modern day company, I view marketing much more as an investment, and a lot of these companies have big R&D lines. R&D, do you view R&D as an expense or as an investment? I view it as an investment. That's why I'm gonna penalize companies for any cost of goods sold. That I agree. That's why I use gross margin. Cost of goods sold, I could never argue that's an investment, right? But anything after the gross profit line, your operating expenses, I think a lot of those are up for debate as to whether they are an investment or they are an actual cost, which is why I think it's much more powerful to use gross profit in this metric rather than use, say, earnings for a PEG ratio, or even EBITDA. So that question that I'm trying to answer on EV over gross profit over revenue growth is, how much am I paying for that growth? How much am I paying for each percentage point of future growth? And so in the case of HIMSS, for example, here I'm paying a 0.09. That is the cheapest stock that I'm going to discuss today. And of course, my spreadsheet has many stocks, a good handful of stocks, 5 or 6, that are cheaper than HIMSS, but they don't achieve that rule of 40. The rule of 40 is your EBITDA margin plus your growth added up, right? So next year, you're going to get 53% more revenue next year. And then you're also stacking the cash flow. You're stacking that EBITDA margin. So you add both the future growth in revenue and the EBITDA margin together in one number. And venture capitalists will tell you, they call it the rule of 40, because if it's more than 40 when you add it up, when you balance cash flow and growth, if you balance it and you have 20 and 20 on each, that'd be a 40. Venture capitalists will tell you, check mark, it's good, you achieve the rule of 40. My goal is I want to go much better than the rule of 40. Why not? And we have a few stocks that are above a rule of 100 on the spreadsheet, but they may not be as cheap as that. So I kind of want it all. I want a cheap stock, I want high growth, and I want the rule of 54 in this case. All of these stocks, the lowest is a rule of 54. So let me get started. And you've read these stocks, obviously, but let me tell you a little bit about each of them. Now that we know that they really fit my metrics, they are what I look for. They're super gems, as I'm going to call it. So the first one is HIMSS. I cannot tell you how many times I've covered HIMSS on this channel. Of course, it came, back in the early days of my channel on this screener, and it still looks cheap. I can't wait until the day HIMSS is not going to be on this screener anymore, and it's not going to be cheap anymore. HIMSS is a company that, frankly, has a business model that's very similar to a SaaS company. It's a recurring business model. What is HIMSS? It's an e-doctor plus an e-pharmacy without insurance. They focus on minor health issues like ED, like hair loss, like anxiety. They focus on the minor stuff, and it's a monthly cost. And with a monthly cost, you get the doctor visit, and the doctor decides whether they prescribe you something or not, and then you get the medication. So they have a business model innovation in how they charge for health. I think it's the leading telehealth right now. It's the biggest telehealth company in the US right now, at least, that uses this business model. And of course, right now, the stock is being dismissed as just a GLP-1 company. 2 years ago, it was being dismissed as just an ED company. And so who knows how long, how many more years this stock is going to be dismissed as just a this or just a that. I think this is a company that has shown its ability to pivot from different conditions and different issues, and I think they will gather a lot of the online prescription and the online doctor, online health world, and I like him very much. It's a big position for me. Another one is Gigacloud Gigacloud Tech. So Gigacloud Tech came recently in the screener. This stock has been on a tear, I guess is how you would call it. It's been up 218%. It's been an outstanding stock, and it is still dirt cheap. How much am I paying for that growth? It's a 0.13. Gigacloud, I hope lovers of Gigacloud won't be mad at me for calling it a drop shipper for furniture, but I'm gonna call it that. It's like it's a drop shipping outlet for furniture. It's a platform where a lot of suppliers can list furniture that they have for sale, and what happens is that if somebody sells that couch online, you sell a couch online or on Amazon or whatever, on Shopify, you create your own website, the best couches, and you sell it on Shopify. The Gigacloud infrastructure will allow the maker of the couch, right, the factory that made the couch, to directly ship to the end consumer, the person that ordered that couch from you on the internet or in a showroom in a town. And so they are the drop shipper for big stuff. And and of course that's how they specialize in this space, because there's a lot of competition in drop shipping, right? And I mean, I can think of a handful of Chinese websites where you can just ship directly to the customers, but typically it's small items. Gigacloud differentiates itself by shipping furniture style, bigger items. This stock may be cheap, of course, because of the state of real estate in the world and less people buying furniture because less people buying homes. Who knows how long that stock will stay cheap? Lots of criticism around this stock. Some people call it a pseudo-China stock, but in my view, they're not. They are a Western company now. At least that's the way I view it. They used to have stronger Chinese ties. I view them as more of a non-Chinese company. I avoided Chinese companies from my spreadsheet. Okay, let me move on. Not ramble here. I will move on. Talking about TideWater. So TideWater is a offshore vessel servicing company. So they have dozens of ships that can cater to the different services, different needs that offshore drilling and offshore rigs in the oil sector, right, may have. And this is a company. Well, first of all, it's cheap compared to 52 weeks ago. It's predicted to grow quite high at 36%, and the EBITDA margin is outstanding. The reason why this company is doing well is because there's been a chronic underinvestment in the building of new vessels, new ships that go out at sea, and they are one of the few companies who has a bunch of ships left and who have not exited the business. And so a lot of people are using their services. I've been studying that company a little more. One of the advantages that they claim about offshore drilling for them is that really offshore drilling is the most profitable form of oil exploitation. And so because it's the most profitable, that means that even if oil were to drop to like $40 or $30, offshore operations would still operate because they are profitable starting at like $20. A barrel of gas. And so as a result of that, a lot of the revenue is highly recurring. This company is just a cash cow, and it's also at 33% EBITDA margin, right? Understandably, and it's also a company that's purported to potentially go higher for the very reason that there's been an underbuilding of these ships. So this is kind of a macro/asset play where they own all of these ships when nobody else own it. And so that's interesting from that standpoint. I like it. I do not own it, but I like it. Moving on to Oddity. So Oddity is my initial original beauty stock, original beauty play. What I like about Oddity is that it's a business very similar to HIMS in many ways, but in the beauty sector. And so the beauty sector, you don't have that barrier to entry of needing a provider that is registered in a state and a doctor and hiring a doctor. So you don't have that issue when you are selling foundation. What does Oddity do? They sell foundation online. They have one main brand called e.l.f. Makiage, and it's a foundation. What is a foundation? A foundation is something to hide your skin or cover your skin. It's women's makeup, obviously, right? And you cover the skin, and what they have, Oddity, is they have an AI. So they are very popular on social media, and it's an AI. If you know anything about makeup, the problem is matching the color of whatever foundation you're going to buy. You gotta match it to your skin color. And there are, how many millions of shades and tones potentially could you calculate? There's, if not millions, thousands of possible different skin tone and skin colors, and how many shades of different skin colors can you have? It's like historically, of course, women historically, they've done this through numbers, and you would buy a foundation based on a number. So you would have like a 350, 355, 250, whatever. Not one-to-one, really segmented, like they would segment it. Oddity is going after this market. They scan the face, they get your exact skin tone, and then they put it in a foundation, they ship the foundation, and of course, a lot of people love it because it's your exact skin color. And so women, when they find a foundation that is the right color, they stick to it. They don't want to go through the risk of trying another brand. And so that's why we're capturing a lot of market share. Obviously, this is a stock that I'm interested in because it's cheap. I think it's cheap, and that's why I want to look at a stock like that. I would not, if makeup stocks were trading like AI, I would stick to AI, right? But makeup stocks are not. For some reason, they are very cheap. We'll get to e.l.f. in the e.l.f. in a second. It's a cheap stock too. I don't know why makeup stocks are so cheap, but I think it's a high quality business. EBITDA margin is 22%, predicted to grow at 33%. Quite special, right? Gross margin. Notice these gross margin on these businesses I'm showing you here. 72% gross margin, outstanding. Of course, I'm gonna love makeup if it's a 72% gross margin. And how much am I paying for that growth? I'm paying a 0.15 per each percentage point of growth. So this is absolutely dirt cheap in my view. Rule of 55 is achieved by this one. Okay, let's talk about Genmab. So Genmab is the fully new stock that I am talking about today, and I need to cover it on the channel because the numbers look very good. So Genmab is a biotech company, and they specialize in therapeutics, antibody therapeutics for treatment of cancer, of other disease. From my early days research is they have two pretty popular drugs with partnership with large distributors of drugs in the US, the big drug distributors like AbbVie, they have a partnership with them. And so a lot of the money that they make is in the form of royalties for these drugs that they have developed. And of course, Genmab, because you're going to make a lot of money from your royalties. Look at that. You're at a 97% gross margin. Absolutely outstanding. EBITDA margin, 34%. Company is still predicted to grow quite a bit, 28%. That is their guidance, by the way, 28% growth. And, they have a 2030 plan with a long pipeline of many, many, many drugs out there. And so, of course, this is a field that I'm slowly analyzing, but I'm seeing a lot of companies that are very undervalued in I'm gonna call it deep health tech or deep genetics, deep health tech, kind of the new wave, right? Lantheus, I covered Lantheus on the channel, but Lantheus is not that cheap, right? Lantheus is not a 0.18 here. On how much am I paying for that growth? Lantheus's growth is much more expensive, right? Lantheus is in the 40s from what I remember. So this is twice as cheap as Lantheus, and it's dealing, of course, with genetic-based drugs. Which, if you look at genomics, genetics, you had three phases in pharmaceuticals. You had the molecules, right? That was traditional pharma. Then you had biotech. Biotech is still very big. Biotech started in the 80s. It's the next wave. It's the current wave that we're in a lot of health. And then you have the genetics and the genomics. So there's a lot of growth coming in that space. The company is pretty darn cheap. Rule of 40 is a 62, so I love that very much. I will cover this company on the channel, and this is a company located in Denmark, and it's available in the US. They have ADRs and everything. So interesting one to me. Now, let me talk about e.l.f. 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 is a makeup company. e.l.f. is the top cosmetics brand among Gen Z and teenagers, according to a recent Piper Sandler teenage survey report where they surveyed something like 12,000 teenagers, something like that. It's their main brand. It's their top brand. They claim to be the best cost. They claim to be a higher quality than the expensive, quote-unquote, prestige makeup brand. And they claim to do this high quality also cheap. Also very, very cheap. And so they claim to be both the best and the cheapest. This is the classic pattern that we've seen in so many businesses. If you're going to be the best and the cheapest, people are just going to flock to you and they're going to want the product. And this is a lot of what their experience is with their growth. So predicted to grow at 39% for a business that is almost 20 years old. I don't think it's quite 20 years old yet. It's still growing quite fast at 39%. They do a lot of sell in physical stores. Last time I saw them in the real world was at Target, and it's true that it looks like they own Target. So go figure. I don't know. I mean, they own the cosmetics sections over there. The EBITDA margin is excellent at 15%. And of course, keep in mind, a lot of these companies, when you see EBITDA margin at 15 or 9 or 11 or 14, but even 33, you get that operating leverage, right? You get that operating leverage. When you have that forward revenue growth so high, the costs are not growing as fast as the revenue is growing. And therefore, since the operating costs are not growing as fast as your revenue, as you're scaling, you get the operating leverage in the form of the EBITDA growth should be expected to be higher than the forward revenue growth, at least for these companies that are still early in their life cycles. How much am I paying for the growth at e.l.f? I'm paying cheap. It's a 0.2. So it's pretty cheap, and it achieves a rule of 54. So quite outstanding if you ask me. Rule of 40 is considered excellent. Rule of 54. But again, all of these stocks, I guess in a 54 on all of these stocks, you're paling in comparison to, say, the next one, which is SMCI. So SMCI, controversial stock right now. A lot of people are saying I would never invest in a company that has had someone alleging somewhere that there may be accounting problems. The CEO came out with a letter and said that the restatement that was going to come was not meaningful for this year. And he said that in the letter. He said it was all fine. Who do you trust? Do you trust the CEO? Do you trust potentially the short seller reports? It's like, in my view, accounting issues, you can restate. This morning, I was reading about the losses of held to maturity assets at banks, right? Banks, many banks are insolvent right now. The only reason why they're not insolvent, the only reason why they're not filing bankruptcy today is because of accounting rules. So you know what I mean? You heard me at the beginning of this video talking about depreciation. Is depreciation a real expense? I don't think depreciation is a real expense. I see old buildings, I see old courthouses, old libraries that have been around for 100 years, that are still used. They've been depreciated over 37 and a half years, right? So anyways, it's just this. We could have a debate about this, and of course, if you're an accountant, you're gonna tell me, "Oh, depreciation is real." Are you gonna kill the machine after it's outlived its life? If you depreciate the machine over a 5-year period and it still works after 5 years, are you just gonna dump it and kill it? And it's okay. All right, it's okay. I'll just buy a new machine because the accountants tell me this machine's dead. No, it's a write-off. So that's the way I view it, right? Some people may entirely disagree, and of course you have issues on the other way with depreciation. With some products, you depreciate much slower than they actually lose value, which is another problem. And then you ask yourself about, say, the telecoms, and then you ask yourself about goodwill. Anyways, this is not an accounting video, I promise. But this is why it doesn't really bother me. It doesn't bother me, and I know it bothers some investors, and if it does, then stay out of it. What I love though about SMCI is that they are the leader in liquid cooling. They claim in the last letter to shareholders from the CEO, they claim to have a 75% share of the liquid cooled server market. NVIDIA's Blackwell, coming in early 2025, needs liquid cooling. It will be a need. And you have the leading company in liquid cooling that is now trading at a discount. NVIDIA trades at a 0.5 on my EV over GP over RG, right? SMCI trades at a 0.2. Now, if I had a full NVIDIA position, I might be less interested in SMCI, but I don't have it because I sold it like Stan Druckenmiller. Like a lot of the top investors. I'm not a top investor. I'm just a random YouTuber. But I sold it. We all sold it. Plenty of us sold NVIDIA. It was a mistake. How do I choose to get back in AI? I choose to get back in AI through my SMCI position, right? And thank goodness I didn't sell Palantir, right? I only sold what I had put in, so thank goodness I still have my Palantir, right? And of course, maybe people are making the same mistake with Palantir. I don't want to fade AI. I want to have an AI play. This is how I do it. I believe this company has been working with NVIDIA for a very long time. The headquarters of SMCI is literally a 10-minute drive from the headquarters of NVIDIA. The founders are both from Taiwan. Their childhood, towns, their towns of origin in Taiwan are 40 minutes away from each other. They're heavily connected to Taiwan in SMCI and NVIDIA. There's a lot of things going for it. And when I look at the number, it's predicted to grow revenue at 64% revenue predicted. EBITDA margin is 9%. I think that will go higher with the operating leverage. And they are a leader in their space. And they were chosen by Elon Musk for XAI, for the giant data center they built in 19 days in Memphis, right? They used SMCI. Half of it was SMCI, half of it was Dell. So I think the market, the fact that it's down so much, and of course it doesn't look like it's down a lot. It looks like over a 52-week, it looks like it's up 85%, but that's because AI is a revolution, and I want to be in the train, and so I'm on this one. And the last one, which this one I can only describe as a gift, frankly, is Celsius. And Celsius is down 38% over the past 52 weeks. How much am I paying for Celsius's growth? I'm paying a 0.24 for a company that has been the hot stock of the past 3 years in the beverage space. It's been the hot beverage in the convenience store. It's been the beverage that's catching on in the US by storm. I'm trying to be objective here. It sells out. It's Celsius. Gen Z loves it, right? Gen Z doesn't like coffee. They love Celsius. It's got the health benefits. It's the Gen Z defining. In my view, I view it as a Gen Z defining drink. And sure enough, Monster was an outstanding investment. I think Celsius is gonna do very well too, and they're now expanding to Europe. And I've covered Celsius many times on this channel, but it achieves a rule of 62, right? So well above the rule of 40. That EBITDA margin is excellent at 23%. Gross margin is excellent at 50%. It's just a space that I want to gain exposure to, and each generation has a generation defining drink. Warren Buffett got Coca-Cola. A lot of later millennials have Red Bull. A lot of younger millennials have Monster. And Gen Z, Gen, are they going to have Celsius? And it's a bet I'm willing to take. And this company is cheap. It's been almost divided by 3 from the peak, 6 or 7 months back. So I consider this a high quality business. But this is just me, and it fits my super gems. So these were my quote unquote super gems. So I tried to inject some qualitative assessment beyond just the numbers. Obviously, this was not investment advice, not financial advice, right? I hope you'll consider looking at my work on other outlets like on Patreon. And by the way, if you're on the Patreon, I'm going to release a new version of that spreadsheet. This is the new version under construction in the spreadsheet. And I'm going to release that, and I'm adding a bunch of stocks to it. And so hopefully we can get to a screener that has 300, 400 stocks and actually find more quote unquote super gems. So anyways, this was not financial advice, not investment advice, just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on X, follow me on Patreon. Thanks for watching.